the Fed left the Fed funds rate unchanged last night, and there is some doubt as to whether it will actually move to tighten this year. The Fed did mention that the concerns over global growth and volatility had impacted on the decision. And we can see here in the chart that shows Fed funds projections as well as market pricing. So let's just have a look at those a little bit more closely. The purple line was implied Fed funds in the market going back to late August, and the green line just below it shows the implied Fed funds immediately post the Fed funds meeting. So it's basically been a 15 to 20 basis point decline across the forward curve, looking at the Fed funds. You can also see that the FOMC dot plot, as represented by the orange or the gold line here, has come down. Well, couple of observations. One, it's well and truly above market pricing still, but it has come down a long way from FOMC dot plots back 1 year ago. The dotted line there shows where the FOMC was about a year ago. So once again, the tightening is being pushed out, and with the Fed obviously now focusing very much on global conditions, but we believe it's also focusing very much on the domestic inflation data. So we'll have a look at that now. And if we look at some of the inflation measures, actually, before we do, let's have a look at where they are in relation to their mandate. So there's a couple of ways. This particular measure here is looking at the, disregard the heading there, but it's looking at the Fed mandate. That's the blue line. So if we thought of the mandate as being a 5% unemployment rate and a 2% inflation target, it's on the right-hand scale, so it's still below the zero, so it's still short of meeting the target. The red line is the Fed funds rate. You can see here previously when it surpassed the target back in 05-06 policy, the Fed funds rate went above what might be deemed a neutral level up to tight conditions. And likewise during the second half of the 1990s, where there were periods where the Fed was above its mandate and policy was relatively tight. So they're still short of the mandate, but looking at in a little bit more detail, the actual inflation numbers, let's have a look at core CPI. Now we're looking at annual change in the CPI, and you can see there it's below the 2% rate at the moment. The PCE price index, that's dropped down to about 0.4%. We can add in the PCE price index in core terms. That's probably the favored Fed measure. That too has fallen away, the gold line, and it's sitting around about 1.5%. And it's been below the 2% level pretty much since 2012. And even then, since the GFC, there's only been probably a 6-month period where it's been above 2%. So inflation continues to undershoot expectations. If we add in wages, we'll just get rid of a couple of these here. We add in wages. Looked like they were picking up with the tighter labour market, but the last number had them falling back towards 2%. That's the ECE price, the ECI wage index. So clearly the low inflation performance, and even in their own forecast, they don't have the inflation moving to 2% until 2018. So there is a real possibility that the Fed will continue to lag in terms of its tightening relative to its previous behavior over previous cycles. Now I just want to change the tune a little bit, and I want to now turn to some asset allocation measures that we look at. Monetary conditions, and this has become a relevant indicator to look at, certainly for the US, but also on a global scale. So let's just have a look at this one at the moment. Now, one of the reasons why that was suggested as to why the Fed may not move was because monetary conditions had actually tightened up in any case by virtue of the stronger currency over the last 12 months and also weakness in credit spreads in the equity market. We run some simple monetary conditions index that use only interest rates and the currency. You can see here we're looking at a global monetary conditions index, a US one and an Australian one. Now just having a look at the US one, it's gone from easy to, it's still easy, but closer to neutral now. So we can see here, so this is that index. You can see the move up, particularly since the mid part of 2014, which represents the currency strength. So monetary conditions in that sense have already tightened somewhat, and perhaps the Fed sitting on the sidelines reflects that. Our global monetary conditions index doesn't include currencies, obviously, but includes real interest rates as well as excess money supply globally, and that's at very easy conditions at the moment, being driven very much by the Europe and the BOJ. Our own domestic monetary conditions index is it's around the other way here, but it's come from what was seen to be quite tight conditions with the high currency and relatively high interest rates. It's now just moved back into a slightly easy, or basically a neutral, I think we should say, position. So that's what's going on in the monetary conditions index. So it tends to favour global equities, and if you dig deeper, you'll find that it tends to be favourable towards Japan and Europe. When we look at the valuation dashboard, now I'm only including US equities and Australian equities, and US equities I'm looking at a CAPE type measure here. So the market has gone from being quite expensive to slightly less expensive. The blue triangle shows the most recent observation. That has also occurred for Australian equities, have moved in that direction, and equity risk premiums have moved from around about a neutral to a slightly attractive. That is, relative to bonds, equities would appear okay, but in absolute terms they're still quite or slightly expensive. The Australian market itself, you can see here, this is a CAPE or a Shiller type PE for Australia. It's come back from sort of one standard deviation expensive, almost coming back closer to neutral. And the equity risk premium, as we can see here, is pushed up after getting back to an average type level. It's pushed back up towards a one standard deviation above the long-term average. So valuations, as has been the case for some time, look okay relative to bonds and cash, but on a absolute basis, still relatively expensive. Finally, I just want to look at some growth type indicators, global growth momentum, and the ones we're looking at here, global IP, G4 and G3 momentum, Chinese IP and our own NAB business conditions, recession on the left, boom conditions on the right. So as you can see there, most of them are around about average to slightly below average. The standout, of course, is China. The Chinese growth or IP growth around about 6%, well towards the bottom end of the range. And global IP itself sitting at around about 2.5% is also slightly below the longer term average. So that's they're the current state of play of some of our asset allocation dashboards and indicators. I just want to finish up now with a quick comment on the domestic growth situation. We hear a lot of talk about the transition from mining-led growth to more domestic sources. Another way of looking at that is to look at the shift in demand on a state-by-state basis. Here, the red bars represent WA, the green is Queensland, New South Wales is blue, Victoria gold. And this is a measure of state final demand. You can see here during the mining boom, we had rates of growth in Western Australia. This is state final demand, as I mentioned, anywhere between 10 or 8 up to as strong as 15, 17%, a little bit less so in Queensland. So clearly the mining related state economies are doing very, very well. Now, of course, it's flipped in the other direction with those two states now contracting in final demand terms. But interestingly, if you look at the shift upwards since 2012 in both New South Wales and Victoria, New South Wales posting fairly consistent growth, somewhere between 2.5 and 3.5%, while Victoria's been a little bit less than that, but improving in the most recent 3 quarters, growth getting up to 2.5, 3. So there is a transition going on, being forced on by the mining sector downturn, but at least those the states of Victoria and New South Wales are now starting to register, well, not spectacular growth, but something around about trend.